Hi, welcome. We're talking about Your Money Matters on NDTV Profit, and my name is Alex Matthew. We just got done with the presentation of the Union Budget for FY27, that is the financial year culminating in March 2027. And there were several key takeaways. Of course, a large focus was on the increase in the securities transaction tax. But for you, the individual, there are quite a few changes in the fine print that should matter to you. And we'll talk about a few of these key changes. For me, one of the big changes that I saw in one of the inside documents of the finance bill, essentially the memorandum to the finance bill, was a change in the tax treatment of sovereign gold bonds. Now, I'm sure that quite a few of you are aware of the sovereign gold bond. It was introduced in 2015 by the government when they tried to reduce the imports of gold. This was essentially paper with no underlying gold, but it captured the value of gold that moment, and the government was trying to get you to shift from buying physical gold into buying this as an investment. And the lure or at least the hook for you was that they would give you a 2.5% interest that was payable semi-annually. And they also said that if you held it for 8 years, that is the full duration of the bond, then your capital gains would not be taxable at the end of it. The latest update, though, has said that this advantage, that is the waiver of capital gains tax, would only be available to you if you had bought it at the issuance. And starting from the 1st of April, that means that if you buy a sovereign gold bond in the secondary market, you won't get the benefit of that waiver of capital gains tax. There are a few implications of that, and beyond that, there's also the underlying movement in the gold market and the silver market that we need to focus on. So multiple aspects. Essentially, we'll be talking about how you should plan now that sovereign gold bond is out of the window if you haven't bought it already, and what you should do with your gold and silver allocation. I'm joined today by Vishal Dhawan, who is the co-founder of Plan Ahead Wealth Advisors. Vishal, thanks so much for taking the time. Pleasure speaking with you. One, what do you make of this? My interpretation was that there could be an increased demand for sovereign gold bonds, at least in the remainder of this financial year before this kicks in on the 1st of April.
Yeah, so I think there are a few, clear things that have come out of this. So one is, the premiums that sovereign gold bonds had in the secondary market, because the primary issuance has stopped for a long while now. There haven't been any issuances at all for a fairly long period. It's been over a year that there's been no issuances in the primary market. Is that whatever buying was happening on sovereign gold bonds was happening only through the secondary market. And those were already sort of resulting in the fact that there was a 5 to 12% premium virtually at all times on the actual price of gold versus what you were buying in the secondary market. So in theory, some of this tax benefit on maturity was getting priced in the way that you were buying those sovereign gold bonds. And I think it's important for investors to keep in mind that if you look at how a lot of this has happened, it is going to create a lot of confusion for your tax now, because the question will be that when exactly did you buy this and at what stage did the tax law change? So to us, it seems like for most investors, they should now be careful about buying sovereign gold bonds in the secondary market, because there are going to be probably different interpretations on how anything bought between, say, Feb 2nd and March 31 is going to be created or taxed on maturity. Because what it also talks about is in the tax provision, it talks about the bonds are subscribed to the time of original issuance. Mm-hmm. So even if you buy it in the secondary market today, you have not bought it at the time of original issuance. Yeah. And therefore, because of that, it is very likely, and in fact, most likely, that you can't really take action today to buy the secondary market sovereign gold bond, because that will still end up becoming taxable.
No, actually, my interpretation of that was starting from the 1st of April, if you have not bought it from a primary issuance, then you will not get the advantage. So therefore, the interpretation would be that if you buy it in the secondary market on or post the 1st of April, then you don't get that advantage. Be that as it may, I think the attempt here is to correct the dislocation of prices that was taking place, as you pointed out, in the secondary market. Is that the right interpretation?
Yes, I think, we've had a very strange sort of pricing mechanism over the last few months, and it started actually towards the second half of 2025, when the rally in both precious metals, that is gold and silver, started to happen. So depending on where and how you bought that particular investment and the sort of vehicle that you used to buy into it, you saw different things happening. So there were times where there were premiums, there were times where there were discounts. So there's been a fairly large price dislocation, and depending on how you chose to buy, you've had different prices and therefore different returns as well. And this is also got accompanied by the rupee falling. And because of the fact that gold and silver tend to do well for rupee investors when that happens, you've had another impact coming from currency as well. So it has been a fairly challenging 6 to 8 months for people to figure out what's been happening. And as long as everything was going up, it all felt good. I think it's only more recently that this has changed.
I do want to point out, by the way, I forgot to do that at the start, but the last issuance of the sovereign gold bond took place in February 2024, and the price that was arrived at for that issuance was 6,213 rupees per gram. This is important because the prices are well above 15,000 rupees per gram even as we speak right now, despite the kind of slide that we've had. And so people who bought even in that last issuance, Vishal, have had a supernormal return. Let's face it, there are no longer products as sweet as the sovereign gold bond in the market right now. But what, in your opinion, is the way to have that gold allocation? And I think it's important to stress here, and we've been speaking about it in the run-up to this crash in gold and silver as well, it's important to look at allocation and not the FOMO kind of jumping into gold and silver that a lot of people have done.
Oh, absolutely. I think, the amount of interest that both these precious metals have garnered over the last 6 to 12 months is tremendous. And I think we need to separate out, the roles a little bit of both of these precious metals, because sometimes it can appear that they're actually doing the same thing. We've always thought that, gold is more like a stability anchor in a portfolio, and it's also a bit of a monetary hedge. So when governments spend too much money, when the dollar starts to get, look like it's not the most favored currency in the world anymore, etc., you will typically find that gold would tend to be that anchor in your portfolio at that particular point. And if you look at silver, it's really this, higher volatility industrial play with some characteristics of, protecting value in terms of an inflation hedge. And therefore, it's important to understand that, even though both are precious metals, they don't have to be treated in exactly the same way. And you can see that in the recent correction as well, that the amount of correction that's happened on silver has been far sharper than what has happened on gold, and vice versa as well. When it was going up, silver started to gallop much more rapidly as compared to what gold did. So I think it's important to understand this and then take the allocation decision saying, okay, now that I'm clear about the roles that these asset classes play or these precious metals play, how do I want to build it into my portfolio? So traditionally, a lot of what got built was around, saying that these exposures need to be between 5 and 10% of portfolio strategically. I think with whatever is happening in the world in terms of geopolitics, the movement away from the dollar, global fiscal positions, which seem much weaker because debt has exploded, I think there may be a case to have a marginally higher exposure. So for people who were earlier looking at 5 to 10%, they might decide that I'm okay with 10 to 15 or 10 to 20. But I think what we've seen is this huge FOMO, like you pointed out, where suddenly the conversation has moved to saying there are supply mismatches, and therefore I need to put all my money to silver or to gold. And I think that is where all the risk lies, because as long as you're doing an asset allocation strategically, I think you're okay. But otherwise, I think it's a very dangerous game to play.
I love that you pointed out what you did. And I think it's a very important, for me, this would be the biggest takeaway, Vishal, of our conversation today, where you're saying that given the kind of scenario that we're in right now, where you're talking about geopolitics that has made headlines practically every second day in 2026. And you have de-dollarization that has taken place. You've had a weakening in the dollar, which usually means good news for commodities and particularly for gold. You have a situation where yields in the US are likely to be heading lower. All of these things are structural tailwinds for gold. And from that perspective, it means that you can have a slightly larger allocation and you can go all the way up to 20%. It's a very important statement that you're making. I'm glad that you're making that statement. But how do you buy into this? Would you prefer, as a lot of people have done, to go through the multi-asset fund route? Because you don't have control about what the fund manager is going to do. A lot of them actually unwound and brought their positions lower as gold kept rising. Or do you go through gold ETFs?
So I think there are two things which are very important here. That it's critical that when you decide to enhance allocation tactically to a asset class, you do that gradually. So it's very, very critical that even if you decide to make that 10 to 15 or 20, you want to do it through a gradual process and not decide to do that overnight just because there's been a sharp correction that has happened. So something like in SIP equivalent is a great idea to actually build this out on a gradual basis. Coming to how do you end up doing this, right? So there are two different types of ways to do it. For a lot of investors who are very uncomfortable with volatility, they will prefer to still go through a multi-asset route because between the equity, the debt, and the gold and silver, and maybe even some international equity within the equity component, all of these can typically combine together in a manner where what you see on a daily basis or on a weekly basis on NAV seems far more measured as compared to when you buy these assets through standalone ETFs or through standalone fund of funds which buy gold and silver. So I think for investors who understand that these assets are going to be volatile because this is a shift which is happening globally, I think it's a good idea to buy these either through funds which combine gold and silver together or through standalone funds or ETFs, but they need to do it gradually. For those who can't handle the volatility which comes with all of this and are very focused on price, I think they still may be better off going through a multi-asset fund.
Okay. I'm glad that we've had this conversation, and the strategic long-term building of a gold into your portfolio is the point to take from this conversation, apart from the fact that Vishal is saying that you can increase your allocation towards gold. Vishal, thanks as always for taking the time. Pleasure speaking with you.
Thank you so much. Thanks for having me over.